To lead in a world that never stops evolving, you need insights from those who are driving change. Welcome to Breakthrough Innovations, where we bring together the top leaders and innovators who are reshaping their industries. I'm JL Heather, the Principal Executive Coach at Center, and in each episode I sit down with game-changing executives who share the strategies, insights, and challenges that fuel their success. In the next 20 minutes, you'll gain practical takeaways to drive your own breakthroughs. So if you're ready to stay ahead, join us here on Breakthrough Innovations. Hello, everyone. Welcome to this episode of Breakthrough Innovations. With us today is Steve Valentor, the founder and president of Polynomial Ventures, a venture capital firm investing in early-stage technology companies. Steve helps grow technology businesses as a registered investment advisor. He also has extensive engineering leadership experience in semiconductors, computers, software, and aerospace electronics, with a deep background in finance. Steve is also on the faculty at DePaul University, where he helps future innovators prepare for entrepreneurship and AI. Steve, thanks for being here. I'm really thrilled to have you and really looking forward to this conversation.
JL, thanks for the opportunity to be here. I'm looking forward to it. This is going to be great. Let's get into it.
Awesome. Absolutely. To kick it off, maybe tell us a little bit about yourself, where you come from, and what led to your current role.
Sure. So I'm a tech guy. I've been in tech my entire career. I'm based in Chicago, and I've spent my whole career here. As an undergrad, I was a math major, and when I came out of school, the personal computer was just being introduced, and I had a lot of experience in assembly language, so I could make computers run really fast. And since the personal computer was just coming out, it was a natural home for me. So 15 years in computer development, then I moved to semiconductors. I did 10 years with embedded processors that enabled things like cell phones and miniaturization of processor-based systems. A few years in software with Wind River, and then I got involved in aerospace electronics, customizing hardware, electronic computers, and video displays to go into aircraft and spacecraft. And all of that led me to become a professional investor, and now I have Polynomial Ventures, which is a venture capital firm, as you mentioned, investing in early-stage tech.
That's fantastic. I got to admit, I have a friend who's a math major or a statistics major, and I always give him crap about it. I'll try not to give you crap about it.
Well, math is the most fundamental science. You know, everything else is just everything.
There you go. I love it. So now you're in venture capital, and I think this is a really great topic to dig into, because I think there's a lot of interest in knowing, when you look at a company, what is it that you're considering? What is it you're looking for? And maybe more specifically to this conversation, what role does innovation, adaptability, or agility play?
Well, that's a great question, JL. So the first thing in venture is your growing businesses. So it's really interesting if you're an investor, from a real investor's perspective, like a university endowment, a family office, or somebody who's got the capital to institutionally invest. They're looking for outsized returns for a portion of their assets. So they're certainly going to invest in fixed incomes and treasuries where they can, where there's almost no risk. But to get the kind of returns that they'd like to see, they need to take higher risk to get higher returns. And there's really three areas. You can certainly go to the stock market, real estate, but all of these are still going to be capped in the 8 or 9% range. The only three where they have the opportunity for really substantial returns are hedge funds, traditional private equity, or venture capital. And of those three, venture capital is the one that really appeals to me, because that's building new GDP, gross domestic product.
Right.
It's building businesses where there were none, and taking great new ideas, especially technology ideas, and building businesses out of them. To me, that's just thrilling and exciting. And it's the most exciting, private equity is sort of squeezing efficiency out of existing companies. Right. And hedge funds is just manipulating the markets and using all the derivatives and they all do well, but venture is the one where it pulls at the heartstrings, and for me it's a thrill.
I love that story. So I like this idea of participating in creating something new. If I'm a small business that's looking for venture capital, what are the things that are going to signal to someone like you that I'm a good investment? Like, what, from a culture perspective, from an innovation perspective, what are the things you're going to look for?
Well, there's got to be innovation there. And when you're investing in early stage businesses, it's really difficult to choose which ones are going to succeed. We know that some percentage are going to succeed, some percentage are not. Some are just going to proceed in mediocrity forever and never find real traction. but we need to make sure that we do well enough that we can pay back our investors. And so every one that we choose, we have to choose with the potential that it could be really big. So if they don't have a market potential, a revenue potential exceeding, say, $100 million within the foreseeable future, a few years, it's probably not a good candidate for venture. There's a lot of great businesses that shouldn't have venture money, that should just grow organically, and those are going to be very healthy and do very well. But the ones that are going to take venture money have to return big, at least a portion of them do. Now, it's really interesting in terms of the founders. We find that they come from one of two classes of genius. So they're either a technical genius who have a product or service and they're going to change the world, and they know that they need to sell it to customers, so they focus on the product and the customers. The other class of genius that we see in startups all the time is the sales genius who says, give me a great idea and I can sell it to anybody. And so they've got this great idea and they're selling it to customers. So in either one of those cases, they're focused on the thing that they're delivering, the product or service, and the customer, as they should be.
Right.
But when you think about a big company, a prospective acquirer, or if they're going to try to do an IPO and they're going to try to stand up to the scrutiny of the analysts before the IPO, they've got to have all the rest of that infrastructure. There's typically, I teach in my entrepreneurship classes, that there's about 7 aspects of a business that you have to have before it's mature. And when you compare a startup company focused primarily on the customers and the product or the service, and a mature company that's got these 7 areas well built out and evolved, that transition from the startup to the mature company is where a lot of the valuation comes from. When you take a look at a small company and you say, how do you do your ERP? And they say, well, what is ERP? I don't know. We sell products to customers and we bring money in. And we say, well, but how do you manage all those materials? And they say, well, we use QuickBooks. And then you say, well, that's maybe not the best thing for a company. You can't manage your inventory really. So you need to have, so then the investor looks at that and says, oh, there's $1 million. What about HR? And they say, well, Sue is really good with people, so she takes care of the HR. You say, well, you have no HR infrastructure. You've probably done some things wrong. You probably have some exposure. That's another $1 million in valuation that you're not going to get. And there's program management. I think there are certain billionaires involved in the U.S. government these days that could take a really good look at program management in terms of getting predictability of development schedules.
Yeah.
What startup? You can think of any startup and say, we've got these great ideas. We're going to make all these great new products. And they're late and late and late and late, and they just don't have predictability. Well, that's mature program management. It's having a professional there to say, what are the milestones? What are the obstacles? What do we need to do to get this thing out the door on time at cost? Because that's what's going to drive the company to growth.
Right. So if I'm hearing you right, number one, solve a big customer problem, something that maybe no one else is really paying attention to, but something that is customer focused and big enough to scale. 2, make sure you have the infrastructure, the predictability to be attractive to a venture capitalist. And 3, make sure as you build that, don't lose your innovative potential.
Yeah, absolutely. So you have to have a market that's big enough, like you said. You have to pick something. You have to pick a problem to solve that at least you can convince the world hasn't been solved yet. But this process of figuring out how to build the infrastructure of your company, this is what we really focus on. So I've been working at this for 40 years roughly, and it's in every small company, it's the same challenge is how do we get that maturity? I went on a mission to try to figure this out. There was a lot of consolidation going on in aerospace electronics back in around 2015 or so. And there were dozens of deals that were done at amazing multiples of earnings. But the biggest one was Berkshire Hathaway bought a company called Precision Cast Parts. And that company was about a $10 billion annual revenue. It generated $1.5 billion in profit. So 15%, that's really good. Warren Buffett, notoriously cheap investor, paid $37 billion to buy that company. And with with $1.5 billion in profit, that's a multiple of about 28 times earnings. Right. So I looked at this for our small company. We were about a $10 million company. And I said, well, we should be able to go out and maybe not get a 28 multiple of our earnings, but we should be able to get a 15 or so. So I hired an investment banker and I took the company out, and the offers came in and they said, we'll give you 4 times or 5 times or 6 times. And I said, no, this is difficult to achieve aerospace approvals. You get the best customers in the world. Once you're designed in an airplane, you're in it for 20 years. And they said, oh, Steve, you didn't mention all that stuff. Well, we'll gladly give you a 6.5 multiple. And I said, no, what about like 15 or 20? So I said, what are the differences between small companies and big ones, and what make up these? So I went on this mission to try to figure that out. And where I found my answer, I took a course called Financial Statement Analysis. And they gave us a project, and they said, during the semester, here's what you do. You take the public statements from these publicly traded companies, and with nothing except those public statements, create your own algorithm to recreate the way Fitch, Moody's, and S&P give you bond ratings. And so, of course, I picked Boeing as my company. This was before they had their current set of challenges. The first pass, of course, you do horribly, and then they teach you over the course of the semester, oh, you do this and you do this. Well, where the key is you take these accounting ratios. We're all familiar with the big ones like price to earnings ratio or return on equity. Right. But there's about 50 of those ratios. And if you calculate all 50 of those, well, what's a ratio? And I'm a math geek, by the way, so endure with me for just a second.
Numbers are fun.
So yeah, what is a ratio other than a numerator and a denominator? Well, if you can take that numerator and denominator and disaggregate those into components that are not readily apparent on the public financial statements, and then you can cancel out ones that you don't need, now you can start to surface this information. So if you want to look at something like sales efficiency and you want to compare it between your portfolio company and a prospective acquirer, there's no metric that you can do to do that. But if you take this financial statements, if you disaggregate them into all these ratios, and then you start to compare them term by term between your portfolio company and your prospective acquirer or an industry average if you're trying to do an IPO, well, now you've got a mechanism that you can create objectives for your portfolio company managers to go after. You can say, hey, we have these deficiencies we've identified. Let's take the next 3 years and bring those into convergence with this prospective acquirer. Now, when we go to try to sell the company to them, we can make a very strong case that we're accretive in every measure. Or we can make a case to the analysts that we outperform the industry averages in whatever area we're trying to do an IPO in. And if you do that, you've got a defendable valuation for your company that is likely to exceed what you would have done if you didn't study it in this way.
No, that's great. And I think, as people, especially in the small businesses, are looking at growing, getting support in how they set that up, how they make those calculations and appear attractive is probably a really big deal, because the small businesses are so focused on just surviving that they really haven't started to make that transition. Now, I know one thing a lot of small businesses are looking at to help them with that transition is AI. When we were talking earlier, you mentioned that there's probably some good reasons to maybe be a little bit wary of AI, to fear AI. So what are the challenges that you see with small businesses kind of tapping into that AI potential, and what should they do about it?
Well, AI is a great area. I'm just going to start teaching. I'm developing a course right now for DePaul. We're going to teach an AI course in the spring quarter. And I just did a video. It's a little long. It's like 40 minutes long, but it goes into the history and kind of the technical perspectives on AI. AI is going to be a really important business segment going forward. But there's a couple of adages to keep in mind. One of the things about AI is that it is computers manipulating data. It's really data processing. Somebody, I don't know who I can attribute this quote to, though I've seen it a lot recently, is AI is whatever computers don't do yet. As soon as they do it, we call it data processing. We get comfortable with it. But when they first come up with something new, we call it AI, and then we get terrified. And if we watch the science fiction, and this science fiction, by the way, of AI goes back to antiquity. There's, in the Iliad, in the Odyssey, there's Jason and the Argonauts have to fight a giant mechanized winged robot that can intelligently lob boulders at ships that approach the Greek shore. So
made by Hephaestus, if I remember right.
Yeah, that's right. Hephaestus. So this is nothing new for us, but we always fear the unknown. but it's really just data processing. Like what I learned in aerospace, if you're going to have, well, like looking at 2001, where the computer locks Dave, Hal locks Dave out of the space capsule, and Dave, of course, doesn't
Yeah.
do well when he can't get back in. Well, in real life, what you're going to end up doing is when you go to NASA and say, I want to build this computer to go with the spacecraft, they're going to say, okay, well, it's going to be the thing that opens the door. If it fails, how do we rate that result? And if it's rated as catastrophic, well, then the engineers are going to have to put an alternative way to open that door. They're going to have a physical override so that Hal isn't going to be able to malfunction and lock Dave out. And so Dave is always going to be able to get back in because there's a way to get in because it was designed in to the aircraft because it was a critical if the failure was catastrophic, then that's the way it had to be designed. And I think all of our AI systems are going to be built that way. So I don't think we need to fear them as much as many are warning, but I do see them as a tremendous business opportunity because if we can improve the efficiency with which we manipulate data, the volume of data, the speed at which we can compute, the amount of memory and storage and data that we can get access to, it opens up all kinds of possibilities that just didn't exist before.
Well, and it's interesting that you're talking about make sure you understand how to keep humans a little bit in the loop. One of the views I've heard on AI is rather than, it really stands for augmented intelligence. It's there to augment human intelligence, not necessarily replace it. And I think that's a really good caveat for the adoption of AI is whatever you do, ensure you have a human in the loop to catch the catastrophic failures and make sure you spent the time to understand what a catastrophic failure looks like. Because if you haven't thought about that, one may sneak by you. So I think that's a really great perspective. And I know we could probably dive into AI for another 15 minutes. But since we do have to wrap up, I want to make sure everyone knows if they do have questions about the venture capital space or even entrepreneurship or what was it? An AI. Yeah. So entrepreneurship and AI, if people have questions about that, since you teach at DePaul, what is the best way for them to get in contact with you to collaborate or work with you?
Well, thanks, Joe. So the best thing, I'm all over LinkedIn. So the best thing to do is to reach out on LinkedIn. If you just look up my name, Valentor, Valentor on LinkedIn, you'll find me there. I do some work on YouTube as well. I've got a half a dozen videos. Or our website, Polynomial, that's POLYNOMIAL-VC.com. Sorry for the length of it. Polynomialvc.com. -vc.com. And I've got all the videos and articles that I've written there as well. And there's a link there where you can contact us. You can schedule an introductory call with us right there from the website.
Ah, fantastic. Steve, thank you so much for this great conversation. I think we could have gone another 15, 20 minutes and not had a problem, but I'm grateful we had the time we had. And then for everyone else who's still listening and made it to the end, thank you. I hope this episode brought you some value and you'll consider leaving a rating on whatever platform you're on. If you know anyone that's looking to get into venture capital or needs venture capital support, I would love it if you shared this episode with them. And then last, remember to take one actionable insight from today, apply it, and let us know how it goes. We'd love to hear about your progress. And thanks again. We'll see you all again next time on Breakthrough Innovation.